Today in Oshawa, Ontario, hundreds of workers have ended what could be their final shift at the General Motors plant in that city.
$4 billion in projected losses, up to $5,000 in added cost per vehicle, and as much as a 20% production contraction across the industrial Midwest. This is not a recession headline from 2008. This is the emerging cost of a deepening trade war between the United States and Canada at the start of 2026. In the first quarter of 2026, Ford and General Motors signaled severe financial strain as tariffs on Canadian automotive components and aluminum disrupted the integrated North American supply chain. What is unfolding behind the headlines is not merely political tension or short-term disruption. It is a level of industrial damage and financial exposure so severe that its full scale has never been publicly acknowledged in Washington. The real weakness inside this escalating trade war between the United States and Canada remains largely undisclosed, and the numbers behind it are far more terrifying than current reports suggest. Today, I will reveal the hidden structural fracture at the core of this crisis, a vulnerability so costly and so potentially devastating that it could reshape the future of American manufacturing in ways few are prepared to confront. The trade war between the United States and Canada was no longer a policy dispute. It had evolved into a measurable industrial cost crisis. Internal industry estimates warn that sustained tariffs on Canadian aluminum and auto components could raise cumulative annual production costs across Detroit manufacturers by more than $15 billion if volume levels remained near pre-escalation baselines. That figure alone represents a material threat to operating margins in an industry where net profit margins often range between 3% and 8% in stable years. Consider the exposure. The United States imports roughly half of its primary aluminum from Canada. Automotive-grade aluminum is not easily replaced at scale. Domestic smelting capacity in the United States has declined significantly over the past 2 decades, and restarting idled facilities requires years of capital investment and environmental approval. In the interim, manufacturers absorb cost volatility. If vehicle production across North America were to decline 15% over multiple quarters, a scenario analysts have modeled during severe supply disruption periods, the economic impact could exceed $100 billion in lost output across manufacturing, logistics, and dealership networks combined. Automotive manufacturing and related sectors account for approximately 3 to 5% of total United States gross domestic product when including the broader ecosystem. Even a 1 percentage point drag on national growth would translate into hundreds of billions in reduced economic activity. Employment exposure magnifies the danger. The United States auto sector directly supports hundreds of thousands of manufacturing jobs and several million additional positions across supply chains, retail, and finance. A sustained contraction of 20% in output could place tens of thousands of supplier jobs at risk in Michigan, Ohio, and Indiana alone. Meanwhile, Canada's upstream position in nickel, cobalt, and lithium, essential for electric vehicle battery production, strengthens its leverage. If battery input costs rise 10% due to mineral bottlenecks or tariff friction, profitability on certain electric models could evaporate entirely. This is where the crisis shifts, from corporate earnings to systemic vulnerability, and what is happening inside American auto lending may be the most alarming signal of all. The trade war between the United States and Canada is no longer confined to steel, aluminum, or assembly plants. It is now pressing directly into the American consumer credit system, a far more dangerous arena. Auto loans represent one of the largest categories of household debt in the United States. In recent Federal Reserve reporting cycles, total outstanding auto loan balances have hovered near $1.5 trillion. That is not a niche segment. It is systemic exposure. Now consider what happens when tariffs add between $2,000 and $5,000 to the average vehicle transaction price. The average new vehicle price in recent years has already exceeded $48,000 nationally. Add tariff-driven cost layers and elevated interest rates, and monthly payments quickly rise above affordability thresholds for millions of households. If delinquency rates rise by even 2 percentage points across a multi-trillion-dollar auto lending market, that translates into tens of billions of dollars in stressed credit exposure. Regional banks with concentrated exposure to automotive lending, particularly in manufacturing-heavy states, would immediately feel pressure on balance sheets. The risk compounds rapidly. Higher prices reduce sales volume, reduce sales lead to production cuts lead to layoffs, layoffs increase loan defaults tighten credit standards. Tight credit further reduces vehicle purchases. This is not theoretical. During past cyclical contractions, automotive credit tightening has amplified industrial downturns. In a prolonged trade war scenario between the United States and Canada, that feedback loop becomes sharper because the cost shock originates from policy rather than pure demand weakness. And once lenders begin reassessing risk premiums, borrowing costs rise further, not just for consumers, but for manufacturers financing new electric vehicle platforms. But the credit stress is only the first fracture. The United States auto industry supports hundreds of thousands of direct manufacturing jobs and millions more across logistics, dealerships, steel processing, plastics, electronics, and service networks. In states like Michigan, Ohio, Indiana, and Kentucky, automotive concentration exceeds national averages by wide margins. If North American vehicle production contracts by 15 to 20% for multiple consecutive quarters, a scenario modeled in severe tariff escalation forecasts, the output loss could exceed $150 billion annually across the ecosystem. Local consequences follow quickly. Housing markets and manufacturing corridors soften as layoffs increase. Commercial real estate vacancy rates edge higher near assembly plants. Municipal tax revenues decline as payrolls shrink. School funding and infrastructure budgets feel pressure. Pension funds with heavy exposure to industrial equities absorb valuation losses. The psychological dimension matters as well. Consumer confidence is highly sensitive to employment security. When manufacturing workers fear layoffs, discretionary spending declines, durable goods purchases slow, retail sales weaken in surrounding counties. Restaurants, small contractors, and service providers feel secondary effects. Meanwhile, Canada continues leveraging its structural position in aluminum, hydroelectric energy, nickel, and cobalt, reinforcing its upstream importance in the electric vehicle supply chain. The longer the trade war persists, the more visible that interdependence becomes. And here is the deeper risk. When industrial contraction intersects with credit tightening and regional employment decline, the issue stops being sectoral, it becomes macroeconomic. Because if this escalation continues, the next shock may not appear in Detroit first. It may appear on Wall Street balance sheets, and that is where the real vulnerability inside the United States economy begins to surface. The trade war between the United States and Canada is now influencing a variable more powerful than tariffs themselves: capital allocation. Industrial investors do not wait for collapse. They respond to volatility. When supply chains become unpredictable, long-term investment plans begin shifting quietly, quarter by quarter. Automotive manufacturing requires massive capital expenditure commitments measured in billions of dollars per plant. Electric vehicle battery facilities alone can require investments exceeding $4 billion to $8 billion per site, depending on scale and vertical integration. When tariff uncertainty clouds input costs for aluminum, nickel, cobalt, and lithium, executives delay final investment decisions. Even a 5 to 10% diversion of planned North American automotive investment over a 3-year cycle could represent tens of billions of dollars in redirected capital. That does not appear dramatic in a single quarter. Over time, it reshapes industrial geography. Once a plant is built elsewhere, it rarely relocates. Meanwhile, Canada has positioned itself as a stable upstream hub within the trade war environment. Quebec's hydroelectric grid offers low volatility electricity pricing for energy-intensive industries. Ontario continues expanding electric vehicle assembly partnerships tied to mineral processing projects. European policymakers are watching carefully The European Union has advanced, coordinated green industrial policy frameworks designed to attract battery manufacturing and critical mineral processing. Asian electric vehicle manufacturers operate within vertically integrated ecosystems that reduce reliance on cross-border tariff exposure. Policy stability has become a competitive advantage. When governments signal predictable trade frameworks, global capital rewards them. When escalation becomes prolonged, investors price in higher risk premiums. The United States still commands the world's largest consumer market and unmatched financial depth. However, scale does not neutralize friction. If aluminum input costs remain elevated and battery materials face recurring tariff pressure, manufacturing margins compress regardless of market size. Capital flight rarely announces itself. It appears in postponed construction permits, deferred hiring plans, and revised earnings guidance. It accumulates in spreadsheets before it appears in unemployment reports. There is also the pension exposure dimension. Major pension funds across the United States hold substantial industrial equity positions, including legacy automotive manufacturers and suppliers. If sustained margin compression reduces profitability across multiple quarters, valuation pressure spreads into retirement portfolios. Municipal bonds tied to manufacturing-heavy counties may also face increased scrutiny. When employment clusters weaken, tax revenue projections must be revised downward. Credit rating agencies monitor those signals carefully. Canada's leverage in critical minerals amplifies the asymmetry. The country controls meaningful reserves of nickel and cobalt, essential for electric vehicle cathode production. If battery input costs rise even 10% due to trade war friction, certain electric vehicle models risk falling below profitability thresholds. The longer the confrontation persists, the clearer the structural imbalance becomes. The United States entered the trade war seeking industrial dominance. Instead, it revealed dependency on Canadian upstream capacity built over decades of integrated development. Global competitors do not need to intervene directly. They only need to maintain stability while North America fragments internally. European and Asian manufacturers gain relative advantage simply by operating within predictable policy environments. And this is where the confrontation shifts from cost escalation to strategic recalibration. Because once capital reallocation reaches a tipping point, reversing it becomes exponentially more expensive than preventing it. If current projections hold into late 2026, the cumulative investment hesitation could exceed $100 billion across automotive, battery, and materials infrastructure. That is not merely a sectoral adjustment. It is a structural slowdown in industrial modernization. The most uncomfortable reality for Washington may be this. The United States retains enormous economic power. Yet in this trade war with Canada, leverage has quietly migrated upstream. Aluminum smelters powered by hydroelectric dams, mineral reserves feeding electric vehicle batteries, and cross-border electricity flows now shape negotiating power more than tariff announcements. But the final and most dangerous phase of this escalation has not yet surfaced publicly. Because when industrial contraction, credit tightening, and capital diversion intersect, the next shock may not come from Detroit or Ottawa. It may come from national growth data itself, and that is where the true cost of this trade war could become impossible to contain. By late 2026, the trade war between the United States and Canada would no longer be judged by tariff announcements. It would be measured by industrial endurance. The question would shift from who imposed pressure first to who absorbed damage more efficiently. The United States entered this confrontation assuming scale-guaranteed dominance. With a gross domestic product exceeding $25 trillion and the largest consumer market in the world, Washington calculated that tariff leverage would force structural concessions. Yet economic size does not eliminate supply chain dependency. North American automotive manufacturing was engineered as a synchronized ecosystem. Vehicles assembled in Michigan depend on aluminum refined in Quebec, transmission components from Ontario, and mineral inputs sourced from Canadian reserves. Disrupting that architecture does not isolate Canada. It introduces friction into the United States production base itself. If automotive output were to decline 20% over multiple quarters in a sustained escalation scenario, the cumulative output loss could exceed $200 billion across manufacturing, retail, logistics, and finance. Even a 1 percentage point reduction in annual national growth would represent hundreds of billions in lost economic activity. Those numbers extend far beyond corporate earnings reports. Employment effects compound political pressure. Hundreds of thousands of direct manufacturing jobs and millions of adjacent roles depend on stable cross-border integration. Prolonged contraction reshapes electoral dynamics in industrial states that historically determine national outcomes. Meanwhile, Canada's upstream leverage strengthens incrementally rather than dramatically. The country controls substantial reserves of nickel, cobalt, uranium, potash, timber, and hydroelectric energy capacity. In a world transitioning toward electrification and resource security, those assets translate into negotiating power. The electric vehicle transition intensifies this asymmetry. Battery pack pricing remains the most critical cost variable in electric vehicle competitiveness. If mineral inputs sourced from Canada face recurring trade war friction, American electric vehicle manufacturers confront margin compression precisely when global competition accelerates. European and Asian manufacturers operate within coordinated industrial frameworks designed to reduce volatility. Policy predictability lowers investment risk. Lower risk reduces financing cost. Reduced financing cost enhances competitiveness. Capital allocation follows stability. If even 10% of projected North American electric vehicle investment shifts toward jurisdictions perceived as less volatile, that could represent tens of billions of dollars redirected over a multi-year cycle. Once diverted, that capital rarely returns quickly. The strategic paradox becomes visible. Tariffs designed to strengthen domestic manufacturing instead expose the integrated nature of North American production. Interdependence cannot be weaponized without internal cost. Canada's advantage does not rely on economic size. It relies on control of bottlenecks, aluminum capacity powered by hydroelectric grids, mineral reserves essential to battery chemistry, energy exports supporting northern United states during peak demand seasons. These are structural levers. The United States retains unmatched financial depth, technological innovation, and military influence. However, in this trade war with Canada, endurance depends less on scale and more on supply chain resilience. If policy volatility persists, confidence weakens before factories close, and confidence is the invisible foundation of modern industrial economies. Once investors, lenders, and workers question predictability, the cost of restoring trust becomes exponentially higher. By the time negotiations eventually resume, balance sheets may already reflect embedded damage. Pension portfolios may have absorbed valuation swings, regional economies may have experienced contraction, industrial modernization timelines may have slipped behind global competitors. The final question is not whether the United States can withstand this trade war. It is whether the cost of escalation exceeds the strategic benefit originally envisioned. Because once leverage migrates upstream toward resource control and energy stability, reversing that shift becomes extraordinarily difficult. And the most revealing numbers may not appear in quarterly earnings. They may appear in national growth revisions and long-term competitiveness rankings that redefine industrial leadership for the next decade. What remains undisclosed publicly is how deeply policymakers have modeled this endurance equation and whether contingency plans exist if contraction accelerates beyond current projections. Because if the structural imbalance continues widening, the next headline may not focus on tariffs or plant slowdowns. It may focus on whether the United States miscalculated the true cost of this trade war with Canada and whether the recovery path will be far more expensive than anyone has publicly admitted. The trade war between the United States and Canada has evolved far beyond tariff announcements and political rhetoric. It has exposed the fragile complexity of an industrial ecosystem built over decades of integration. What began as a strategy to reinforce domestic manufacturing has revealed how deeply interconnected North America's economic architecture truly is. The United States remains one of the most powerful economies in the world, with unmatched financial markets and technological innovation. Yet power alone does not neutralize supply chain dependency. When aluminum, energy, nickel, cobalt, and lithium flow across borders thousands of times per day, friction becomes cost, and cost becomes contraction. Canada, often underestimated in global industrial narratives, has demonstrated structural leverage through resource control and energy stability. Its hydroelectric capacity, mineral reserves, and diversified trade partnerships position it as a strategic anchor in the electric vehicle transition. In a prolonged trade war scenario, upstream control becomes more influential than downstream assembly capacity. The stakes are not limited to corporate earnings. They extend to employment across Michigan, Ohio, Indiana, and beyond. They extend to consumer affordability, auto loan stability, pension fund exposure, and national growth trajectories. If production contraction reaches sustained double-digit levels and investment hesitation surpasses $100 billion over multiple years, the macroeconomic drag could redefine competitive positioning for the next decade. Industrial leadership is not lost overnight. It erodes incrementally through cost escalation and capital diversion. This confrontation ultimately raises a fundamental question. Is this a bold strategy to reassert industrial sovereignty for the United States, or a risky escalation that strengthens Canada's leverage while weakening North American competitiveness as a whole? The answer will not be determined by headlines. It will be determined by output data, investment flows, employment numbers, and the resilience of integrated supply chains under pressure. For in-depth, fact-based analysis on global trade, industrial power, and economic strategy, subscribe and follow for continued coverage of the forces reshaping the United States, Canada, and the future of this trade war.